This is $10,000. Nothing unusual about it. Same bills, same value, same $10,000. But put this money in the hands of two different people, and something strange can happen. One of them could lose thousands of dollars to taxes. The other? His tax bill could legally be zero. At first, I thought the explanation was obvious. A better accountant. Some obscure loophole. Maybe one of those tricks wealthy people whisper about behind closed doors. But the deeper I looked, the stranger it became, because the difference wasn't really the money, it was the story behind the money. And that story begins with two people, Sarah and Marcus. By the end of the year, both will have generated roughly $100,000 in economic income. Sarah earns hers from a corporate job. Marcus owns a small business. From the outside, the result looks almost identical. Sarah, $100,000. Marcus, roughly $100,000 in profit after legitimate business expenses. Same number, so you'd expect roughly the same tax reality. But this is where the first crack appears. Sarah opens her paycheck. The money has already been touched. Taxes were withheld before her salary ever reached her account. She earned the money. The system took its portion. She received what remained. Marcus's money took a different path. Before his business arrived at its profit, it paid for things it legitimately needed to operate. Software, equipment, business travel, certain qualifying workspace costs. Those expenses reduced the profit subject to tax. And that's when the first piece of the puzzle clicked. The tax system doesn't see every dollar the same way. It wants to know the story behind it. Salary, business profit, investment income, capital gain, the number printed on the dollar doesn't change, but its journey through the tax system can. Suddenly, our original $10,000 made a little more sense, except we still had a problem. This explained paying less. It didn't explain zero. So I kept looking. And that's when the story crossed an ocean, because I discovered something bigger. Countries don't even agree on what income belongs to them. Imagine a company registered in one place, with customers somewhere else, and the actual work happening thousands of miles away. Who gets to tax the profit? I assumed the answer was obvious. The country where the company was registered. It wasn't, and that led me to Hong Kong. Hong Kong uses a territorial approach to profits tax. In simplified terms, one of the critical questions isn't simply, where is the company registered? It's, where were the profits actually generated? Under the right circumstances, profits sourced outside Hong Kong may not be subject to Hong Kong profits tax. For a moment, I thought we had found the answer. Register the company. Generate the income elsewhere. Zero tax. Mystery solved. Except, tax authorities thought of that too. They can look past the address on a company document. Where does the real work happen? Where are decisions made? Where are contracts negotiated? Where are services performed? A foreign address doesn't magically turn local activity into offshore income. So the door that looked wide open suddenly became very narrow. But it revealed something more important. We had been asking the wrong question. Again, first, how much did you make? Then, how did you make it? Then, where was it generated? But there was one question left, and this one changed everything. Where are you? Not your company, not your bank account. You, because eventually every path led me to the same phrase, tax residency. Where you genuinely live can dramatically affect how your income is taxed. Not where you vacation, not where you opened a bank account, where your actual life is. And follow that trail long enough, and you eventually arrive in Dubai. More specifically, the United Arab Emirates. Imagine earning $100,000 a year, then $500,000, then $1 million. Normally, you'd expect your personal income tax bill to rise with your income. But in the UAE, there is generally no federal personal income tax on an individual's salary. Not a lower bracket, not a millionaire discount, no federal personal income tax on salary. And suddenly, the $0 receipt from our opening scene didn't look so impossible anymore. Maybe there was no secret loophole. Maybe the person holding that $10,000 simply lived under a completely different tax system. Which raises an obvious question. Why doesn't every wealthy person just move to Dubai? And this is where the story turns again. Because visiting Dubai and genuinely changing your tax residency are two very different things. A plane ticket doesn't change your tax life. Neither does a bank account. Neither does an apartment you barely use. Authorities can look at where you actually spend your time, where your home is, where your strongest ties are, where your life really happens. Changing your tax residency can mean changing your actual life. But suppose you did. You moved, established real residency, followed the rules. Are you finally done? For some people, maybe. For others, not even close, because there's one passport that can dramatically change this story. An American one. Picture two neighbors in the same Dubai apartment building. Same floor, same income, same lifestyle. One is British, the other is American. But when tax season arrives, their situations can be completely different. The United States generally taxes US citizens and resident aliens on worldwide income. Moving overseas doesn't automatically make that obligation disappear. The American could spend most of the year in Dubai and still have US filing obligations, and potentially US tax liability. Certain exclusions and credits may reduce that liability when their requirements are met. But "I moved to Dubai" is not a magic sentence that makes the IRS disappear. And that's when everything started falling into place. Every time we thought we'd found the secret, there was another layer underneath it. Own a business. There are rules. Move the company. There are rules. Change countries. There are rules. Change your residency. Your old country may still have rules. And that's why the internet version of this story sounds so much easier than reality. Open this company. Move here. Pay zero tax. 3 sentences can leave out the most important part, the rules. There's a huge difference between tax planning and tax evasion. One works within the law, the other breaks it, and confusing the two can turn a clever-looking strategy into a very expensive mistake. So I went back to the beginning, back to the $10,000, but now I saw it differently. At first, I asked, how can one person pay thousands in tax while another legally pays zero? That wasn't the real question. The real question was, what happened to this money before it reached their hands? And suddenly, the puzzle clicked. Imagine 4 people. One earns a salary, one owns a business, one owns investments, one genuinely lives under a different tax system. They could all end the year with money in their accounts. But the tax code may see 4 completely different stories. That's the part most people never see. We obsess over the number. $10,000, $100,000, $1 million. But the number is only the surface. Underneath it is a structure. What produced the money? Who owns what produced it? Where was the income generated? Where does the person actually live? Which country's rules apply? Suddenly, how much do you make feels like only half a question. And maybe that's why stories about wealthy people paying very little tax sound so unbelievable. We see the final number. We don't see what sits underneath it. The business, the assets, the country, the residency, the rules, and no. That doesn't mean you should move to Dubai. It doesn't mean you need an offshore company, and it definitely doesn't mean copying a tax strategy from a 60-second video. The lesson is simpler. Stop looking only at income. Start understanding the structure underneath it. Because now we can finally return to where this story began. $10,000 in one hand, a $0 tax bill in the other. Same money. But now you can see everything that was hidden outside the frame. The person, the business, the assets, the country, the residency, the rules, the entire structure behind those $10,000. Most people ask, how much can I make? People who understand the system ask 3 more questions. What will I own? How will I earn? And where will it legally be taxed? Because 2 people can make the exact same amount of money and live in completely different tax realities. There's still one part of this story we haven't touched, maybe the most important part. We've talked about where wealthy people live. We've talked about how they earn, but not what they actually own. And once you understand that, the story changes again. That's next. Subscribe if you want to see it. Quick note, this video is for general educational purposes only and isn't individual tax or legal advice. Tax rules depend on citizenship, residency, income, business structure, and personal circumstances. Always verify your situation with a qualified professional.